Okay, thank you all for joining. Again, if you can't hear, just log off and come back on, and it should work. The thought on this was I was asked to present to a University of Houston business school class recently, and we pulled together some slides, most of which is information we've shared previously, but pulled them together to address sort of macro perspectives in oil and gas investments. And this may seem redundant to some extent as a topic, but this was the this was the request for the class, and having put it together, thought we'd share it publicly. And so I think, and the one change that we made is there were three slides or so that we had actually had in prior presentations that we had cut out for this, and that were relevant for questions that were asked, and so we've included them in this. So again, thank you for joining. Hopefully you're able to hear this, and interesting times, and we'll address that. Yeah, here we go. Okay, so just real quick, this is not an offer, solicitation, or recommendation. Please consult an advisor before making any sorts of investments or investment decisions. A little background on us and the performance for all of the things on the bottom is now worse as Liberation Day liberated many remaining profits for those active in the oil and gas sector on the long side. We've been running Bison for just about 10 years now and have materially outperformed relative to the small cap index and relative to even larger cap oil and gas stocks, despite small cap underperformance. I was chairman of the board of one of the companies we were invested in for a period of time, and we sold it at a nice profit. And we focus mostly on upstream oil and gas companies on the public side, and then also selectively invest in midstream and oilfield services public companies as well. So what we're going to do today is go through a little bit of a oil and gas macro overview, which I guess is particularly relevant as Saudi is threatening via leaks to news reporters to bring back significant withheld production onto the market. So we're going to talk about oil and gas macro as we see it right now, how we use that macro view to position around the cycle, and then what the benefit is of focusing on value and valuation in the context of a sort of macro driven industry and macro driven public equities. So very high level, whether you call these quads or call them different points in the cycle, there is a very basic intrinsic cyclicality to oil and gas investments. And this framework, I think, is relevant for a number of different cyclicals and for thinking about many different commodities and other cyclicals beyond just oil and gas. But the basic idea is that if you start out with where we think we are right now, low prices reduce investment and lead to underinvestment, which eventually leads to undersupply. As that underinvestment leads to undersupply, it yields rising prices, which eventually induces incremental investment. And over time, as there's enough investment and enough time, prices will have risen to a high point, but there also have been a lot of investment for a number of years. And that investment ultimately leads to oversupply and falling prices, which leads to a reduction in investment and then back to low prices. Again, this may seem simple and simplistic, but I think it's really helpful to sort of keep this sort of chart in mind and try to map where we're at from a cyclical perspective. And I think it's also helpful to think about sort of how long these things take. And the measures we've seen is that the typical oil and gas cycle can take anywhere from 7 years to 20 plus years if you include sort of the full low price and high price periods. And there's often a lot of complexity where a period of high prices will end due to a recession, which in some cases may be induced by high oil prices. So, this is probably one of the most important aspects of our thesis and understanding of the oil and gas market. And frankly, I think using that cyclical framework is only relevant if you agree with this approach, which is that oil demand has grown by about 1% a year for the last 50 years, and that it will likely continue to grow by about that. If you think that oil demand is going to fall at some point in the near or medium term, then it would not really fit within that sort of cyclical framework. It would be sort of a more secular question. And remember, everything we see, and we do a lot of work on this to try to track, hey, is there some sort of big deviation or shift? Various environmental driven approaches towards net zero have failed, including a recent prolonged blackout across the entirety of Spain and Portugal and parts of other European countries. And as these policies fail, we've seen there's been a tendency um, for relaxation of some of the policy aspects. And then even when they're fully implemented or nearly fully implemented, like we've seen in countries in Scandinavia, for example, the per capita demand for oil is still much higher than you see in countries like China and India. And so there is this sort of, from what we see, an inexorable long term 1% oil demand growth trend, which may be above trend or below trend depending on the year, may be affected by short term. Economic cycle and other questions, and was obviously very significantly affected by COVID and government mandated shutdowns around the world, which you can see in that significant drop in 2020, but otherwise has held for quite a long time. And the one other thing to point out is that when demand has fallen, it's typically, especially around either cyclical factors or around COVID, you actually see a recovery at a much faster pace than the long term rate until you get back to that sort of 1% annual trajectory. So I think this is probably one of the most important aspects of um, our view on oil markets. And again, it's our analysis and our essentially view and assumption. And I think if this holds, then that cyclicality should hold. And frankly, even if it doesn't hold, there's so much underinvestment that you may experience a period of higher prices, but the dynamic would be very different than how we see it. So here's a view on the structural underinvestment in oil and gas globally. And this is, I think, the global view on upstream spending in the industry from 2010 through 2024. And it is interesting because over this time frame, demand has increased substantially. Going off memory, I think you were at closer to, let's say, 85 to 90 million barrels a day of demand in 2010 versus, and we were just recovering from the global financial crisis. That was actually a subdued year due to economic weakness and a recovery, a slow, well, actually, it was a fast recovery in oil prices, but a slow recovery in oil capital expenditures. And so there was a period of time of close to 900 billion to $1 trillion a year in upstream investment in oil and gas, and that fell dramatically inflation adjusted. That would be closer to, let's say, closer to a billion, or sorry, $1.5 trillion of investment versus recent investment of close to 600 million. There's some complexities where there's improvements in rig efficiency, but there's also a reduction in the size of fields that are discovered. And so we think on a longer term basis, these sorts of numbers are helpful proxies. Obviously, any individual year, there wouldn't be too much meaning, but over time, these things add up sort of in both directions. And we think that one of the things that will get us scared and likely get us to reduce our investments substantially in oil and gas would be if we got back to a period of sustained much higher prices, much higher investment like we saw in that 2011 to 2014 type timeframe. That would be scary because that would likely be that sort of higher price environment that we talked about. Inflation adjusted prices were close to $150 a barrel WTI at that point. And so in that elevated capital environment, there's the potential for there to be longer term production and reserves that would come on, and that could provide a cyclical oversupply. Again, we're in the opposite camp or sort of opposite place right now. And then when you inflation adjust these things, that would imply necessary capex well in excess of where we're at, likely close to double current investment levels, potentially just to sustain current production due to underinvestment for so long, and maybe it would take 3 or 5 or 7 years. And what we don't show in this is that there was an enormous ramp up in capital expenditures from 2001, which was sort of the trough of the last oil cycle, up even to 2010, where you saw capital expenditures soar over that time frame. And this was at the so we're showing the tail end of the last cycle, and now we've seen a period of very low investment, which has yielded continued disappointments in reserve replacement and discoveries. And we're starting to see the short cycle spots that had absorbed a lot of the investment post 2014. We're starting to see shale roll over in the US. And so that would actually call for potentially even more investment rather than less. Another way to look at this is looking at the performance of oil and gas stocks generally versus the market, where when we look at past cycles, we saw material outperformance, particularly from the, let's say, 2001 to 2008 timeframe, where oil stocks massively outperformed the market and induced a lot of that capital. And there was momentum from that outperformance that extended into 2014. And that capital eventually again crushed the oil market. Well, we're in this period that's the opposite of that, where larger cap oil stocks, which you see with XOP, are down a bunch. Oil field services are down even more. PSE, the small cap oil producers, are down even more. And what we think you'll need to see is material outperformance, likely driven by price increases and concerns of shortages. And that would, we think, induce material capital investment. And so we think there's room for the small caps to catch up with the larger caps, which would be basically them doubling from here. And I think this is actually not even incorporating the recent move down, but you need them to double from here or potentially more just to catch up with some of the larger caps in oil and gas. You'd need to see the services names massively outperform, and then you'd need to see them start to materially outperform versus the market, likely to induce the capital investment necessary to kick in some of that high prices lead to low prices type cyclical dynamic. So again, we think in the Bitcoin world and certain other sort of hotter money, more speculative type things, they always say you're so early, but then you look at a chart and the thing is up 100x or 1000x or whatever. In this case, it's so early that many think that it's just dead and never recovering. And so, it's quite exciting to get to see something like this and have the opportunity to be able to deploy into it, and then even to own things. And, it's a lot of oil and gas stocks are down today. Oil prices are down today. Sentiment is extremely negative. Frankly, a number of the remaining oil bulls that we had tracked, or fund managers or analysts or TV pundits or what have you, have capitulated and are no longer positive on the sector, and particularly on the oil related producers and services companies, which are the bulk of the sector. And we are quite excited about that, as well as quite excited about what this lagging historical performance could mean in terms of the magnitude of the move necessary to induce the capital to move us from a low prices lead to low supply part of the cycle to a high prices lead to oversupply part of the cycle. So again, we're very early. Yes, there are questions about OPEC. Yes, there are questions about tariffs. We'll address both of those. But we think from a sort of broader macro perspective, these are the factors that matter more and will drive future potential performance much more so than some of the shorter term noise. So, considering the recent news on OPEC and OPEC Plus and some of the extreme market concern, as well as some of the flat price, sort of the spot price for oil moves down, thought it made sense to share some analysis from this Raymond James analyst from last year. It was on a podcast on YouTube, so pulled it, cited it here, and they thought that last year, October or so, that there was about 1.2 million barrel a day of spare capacity versus the consensus number for OPEC Plus, which is 5 to 6 million barrels a day. The 5 to 6 million barrels a day makes no sense to us because we think that this analyst at Raymond James has it right in the sense that if you have Kazakhstan causing problems because they're overproducing versus their quota by 400,000 barrels a day, for example, why does it make sense to not include that in their in the consideration of potential spare capacity? And then on the flip side, you look at countries like Saudi Arabia, which have never produced for more than a month or so over 10.5 million barrels a day. And so when you look at sort of what they've shown, even at ultra high prices, right? Even in March or April of 2022, with oil prices spiking and concern around the Russia-Ukraine war, you still didn't see Saudi Arabia produce that much. And then even in the market share price war in 2020, which many people are referring to now, and there's even some talk of negative oil prices, potential for that. They only got to about 12 million barrels a day, and that included significant drawdowns of their local storage as well as storage that they held externally. So maybe they only got to 11 million barrels a day of production. It was only for a month, and then there were significant repairs that needed to happen for quite a long period of time. So we think that the broad concerns around OPEC plus flooding the market are overstated at best. And when we look closely at what OPEC Plus has said and done over the last few years, we think they're actually concerned about underinvestment broadly over a multi-year period. And they've actually publicly encouraged folks to invest more in oil and gas rather than trying to discourage investment, even as they've tried to maintain compliance with their quotas and so on. And so that's a very big departure for OPEC and OPEC Plus versus the messages that the member ministers have, energy ministers of these various OPEC Plus countries have said publicly prior to this time frame, where they weren't necessarily encouraging investment in long cycle production in the, certainly not in 2014 or 2015. And the message has been in 21 and 22 and so on, to actually they've been encouraging more investment rather than discouraging more investment. And again, I think this may be why, and this may also be why they're bringing some production back onto the market, whereas they increase quotas, they're not actually increasing that much production because of some of the cheating. And as they bring on some of this production, I think more people will focus on how much remaining spare capacity there is for OPEC plus. And as people better understand what happens as these countries bring back on production, I think people will be surprised potentially to the upside. And it looks like some of their analysis and some of their consultants and some, if you look at some of these reports, are actually less bearish than you would expect considering some of the news flow. So I think it makes sense to think about this, pay a little attention to it and keep it in your mind, maybe be a little less scared about some of the news flow around it. I think at the same time, it makes sense to think about what's happening with global oil inventories versus prices. We saw yet another weekly oil inventory decline of oil plus crude plus distillates in the US. And those are imperfect on a weekly basis, but over time they add up. And I think people missed it because they were so focused on the OPEC news today. But when you look at it, there was also a monthly report which showed that the US was actually producing 300,000 barrels a day or more less than what the weeklies are showing in the month of February. And that's not even a weather adjustment, because the extreme weather that we experienced this year was in January. There was very little weather disruption in February. And so I think you're going to see some revisions down in EIA stated US crude supply, which will help explain some of this inventory draw and may actually exacerbate it as numbers are adjusted and corrected down. And the open question is, hey, is this 2014, right? Are we about to see prices fall after inventories are sort of ahead of inventories rising, or is this sort of a bad signal and ultimately this correlation which has held over time will prices rise to match the declines in inventory. This is from Open Insights from their public posts. And we've seen similar charts looking back way further than this. This is a correlation that unsurprisingly has held, where lower inventories tend to be highly correlated. Global inventories tend to be highly correlated with higher oil prices and vice versa. Inventories are really where supply and demand meet. The sort of error function on that based on whatever the current price is inventory. And so in aggregate over time, it's a good way to track whether the market is over or undersupplied. And right now, based on the current market and current data, despite the price move down in oil, the inventories are signaling a significant undersupply in the market. That could change. And again, a couple of times historically, this has led to it's actually been a bearish signal, but other times it's actually been a quite bullish signal. And sort of the fundamental message here is that the market is undersupplied, which is in line with what we're seeing and in line with what we'd expect to start to accumulate, which would be material undersupply that grows over time as demand grows by 1% or so, and investment doesn't, as we showed in that sort of multi-year capital expenditure chart for the industry. So flipping just very briefly to natural gas, we got quite bullish natural gas Q4 last year as we saw the rig count for natural gas disappoint. And at the same time as investment fell, more and more liquefied natural gas projects, export projects were approved, were funded, went under construction and started to turn on. And so, the price gap between US natural gas prices and European and Asian natural gas prices has fallen a little. And obviously there are some short-term risks around tariffs and so on. But the usefulness of natural gas is so extreme, and the increase in global demand to the extent that global LNG prices fall towards, let's say, $8 an MCF, is so great. There's such a deep potential demand for that over time we see a potential significant disconnect between the current price for natural gas and the price necessary to induce enough investment and enough supply to be able to supply all of these facilities. There's also been a technology change where the last couple of facilities built here in the US were built on a modular basis rather than on a sort of custom basis, and that collapsed their build time. And we think it will also lead to much lower construction costs over time. So we're pretty bullish on LNG facility buildouts. We're a little less bullish on data center buildouts. We think there will be some, but they're just an order of magnitude smaller. If you look at just the incremental potential 15 or 20 or more BCF a day of export capacity coming on likely by 2030, and the potential for even more of that as projects that are permitted get funded and into construction is very, very large versus the potential for near-term data center buildouts and demand. And so we just see this market as really undersupplied. And then if oil prices were to stay low for a period of time, which again is not our base view, that would actually lead to further lack of supply due to reduced associated gas supply, and that would lead to potentially even higher prices. And this market is not clearing right now. We're actually seeing likely significant undersupply by later this year from LNG projects coming on right now, as well as comparing the guidance and rig activity that's oriented towards dry natural gas right now. So really exciting. We think basic macro backdrop, and it's actually getting better, not worse. Again, the tariffs are sort of a mess for this. One of the negative impacts, ironically, is that even though there's this push for more stuff made in the US, including these LNG facilities, the construction process is getting complicated because sourcing the parts to build these facilities to be able to export US natural gas has gotten complicated, and there's uncertainty around tariff rates and availability of inputs to be able to build some of these. So there's sort of this sequencing problem on the tariffs that's leading to a lot of uncertainty and has frankly hurt the short-term price for natural gas in the spot market, which is ironically reducing investment in incremental supply. But there is this demand that's coming, and I'm confident that these 20 or 10 or $30 billion type projects with multiple trains coming on they'll resolve some of these supply chain issues. Some of them were built in the middle of the COVID or post-COVID supply chain crunches, and so this is relatively minor compared to that. So there's going to be a lot coming on, and there's not enough supply, and the CEOs of these companies, as well as some of the specific analysis we've done on fields and projects and wells and so on, indicate a much higher price, closer to, let's say, $5 an MCF versus the current 350 or so, is going to be necessary to get that market to clear. And then there is this right tail potential where if there's extreme weather, or if there's more supply disappointment, or for example, if oil prices stay low or go lower, then there's disappointing associated gas supply, you could end up in a scenario where you have shorter term natural gas prices far in excess of that $5 an MCF. Again, just showing how much supply has been added for natural gas over the prior decade of about 30 BCF per day. But a lot of the fields that were aggressively developed to supply that incremental supply have limited remaining inventory, and in some cases have limited remaining takeaway capacity. Like, for example, Appalachia has very little remaining pipeline capacity. And so it's going to be pretty hard to grow supply from there. And then from West Texas as well, it's been a large incremental source. There are some pipelines coming on, but it's going to be quite tough. And there's going to need to be a lot of pipe built to potentially supply the likely incremental demand for natural gas by 2030. And then that number actually could have upside bias depending on the impact of tariffs and the price path for natural gas, as well as any sort of government subsidies or permitting or so on for additional LNG export facilities. And then it is worth noticing that the long-term supply for natural gas has been quite robust, where we're up by 30 BCF a day over the past decade. But the short-term supply growth for natural gas has been quite anemic, with supply roughly flat year over year, up slightly right now on a seasonal basis, but pretty meager over the last year. And over the last few years, a pretty disappointing amount of incremental supply of natural gas. And we think that may actually get worse, not better, absent materially higher prices to induce investment. It's sort of a microcosm of the oil thesis, where because of this much faster growth in export capacity than you see in oil demand growth, you're seeing sort of an acceleration of a cycle and a pull for gas that is much larger than the amount of incremental supply. So it's basically what we're seeing in the oil thesis. It's just happening a lot faster. And that's one reason to call it out specifically. The other reason is that a lot of the profitability of oil and gas producers in the US, along with the services companies, is driven by a combination of oil and natural gas prices. To the extent that we get a period of $5 plus natural gas prices, along with much higher oil prices, you could see exceptional profitability, both for the producers and services companies, as well as on an individual sort of well level or project level basis, which could be enough to induce substantial incremental investment and also may drive share prices way higher. And so that's sort of what we're seeing the potential for and what we're expecting. Again, feels weird on a day where the spot oil price is down 3.5% or so as we're talking. And yet there are these sort of fundamental views, and it's really helpful to have done the work on these, to understand them, and to understand sort of what may be happening in the market, to be able to have conviction to actually go and do what we've been doing today. And again, this is not a recommendation, but we're adding to our positions today, and real excited about the prices that we're able to buy some of these stocks at. So positioning around macro cycles. One thought on this combination of tariffs and OPEC plus concerns is that when you look at where people get most worried, it's tended to lead to much higher forward returns. And so, people talk about this a lot, Peter Lynch and Buffett and many others, where, if a product goes on sale, you want to buy more of it. That's human nature. But when a stock goes on sale, people get scared and sell it instead of buying more of it. And so when you look at oil stocks in the 2008 recession and the COVID pandemic, and then you look at how they performed in the last 12 months, and this is somewhat updated, but the small caps are down even more than this 27%. The time to buy them has been where there's sort of this peak type fear, and the forward returns from I like to joke, hiding under my desk and clicking buy has been pretty substantial for oil stocks generally. We've done quite well at Bison with this, although the flip side to this is owning stocks that have done this well has led to in line roughly performance with the small caps subsequent to that, and actually a year or two of underperformance. And there's always some trade-offs with everything, but it's pretty interesting when you look at, say, hey, prices are down, people are concerned, what do you do? And the sort of modern finance answer is, oh, you sell. And oh, if you don't understand it, you sell. And again, we think it's really important to understand it both on a macro perspective and on a position perspective. But facing into the fear and buying when everyone else is scared and selling has worked really well for us. And frankly, the math is that it works really well for the sector at these different periods. Again, we're not down as much as stocks were down in 2008 or at the peak of the COVID pandemic when prices went negative. But oil futures positioning is really low and valuations are really low. And so we think it's very similar. And we don't have an answer for how bad it gets right now. I don't think anyone really does in either direction, however they're betting on this. And so we think it makes sense to consider sort of what the upside is from sort of closing our eyes and buying more while there's sort of this sense of significant panic or fear. And then when you look at what the impact is, I still remember I had a call with a broker in February of 2020, and my view was that they wouldn't shut down the world because there were various mortality stats, and it was a bad idea from a policy perspective. Copying China's policy on almost anything has been a bad idea in the last decade plus. And we did it, but I didn't think we would. And so my thought was, hey, oil and gas stocks are cheap. I'll go buy more of them and deploy some available cash in February of 2020 on the back of a drawdown in small caps. And those stocks over 3 years were up close to 700%. And it didn't feel great in April of 2020 when those stocks were down another 50% from where they were in February 2020, but they were still up 700% or so over the next 3 years. And so, and just if you just bought the index, you bought an XOP, not even a small cap index, you were still up. If you bought it ahead of oil prices falling or going negative or anything like that, you bought it in January of 2020, you were still up. If you just bought XOP, 150% 3 years later. And so I think the observation is, hey, when the market does poorly and a sector does particularly poorly, facing into those fears and buying where people are selling and scared and negative, and where even the people who are most persistent through a bull market have capitulated. Honestly, those have been sort of the very, very best and most promising times for Bison. And then we've seen that for these indexes. So again, it's not all about timing the absolute bottom. We're not sure that it's even possible to do that, but to the extent that it were possible to do that, giving oneself a lot of grace around the timing of that, I think makes sense, because it almost doesn't matter. 1,000 whatever percent return is much better than a 700% return, but getting that 700 or 500, or you look at the ETFs, the 150 or 200 is way better than not. And again, none of this is a recommendation. Past performance may not be indicative, but these cyclicals do seem to rhyme to some extent. And I think it's helpful when you look at market timing approaches and claims and services and so on, and you track their actual performance. Market timing is quite difficult, but buying when literally blood on the streets, or when everyone's sort of scared, and when price performance has been very negative for a while, looks like it's a effective strategy and did very well for us in a similar sort of uncertain and sort of extreme drawdown time frame. So one other way, how do you tell that you're in that sort of situation? So one is just looking at sort of the absolute performance. Another is to look at fund flows by investment funds, by advisors, and you can see energy is massively underinvested. None of this is a guarantee. These are charts from Deutsche Bank and Bank of America from we pulled from social media, and um, none of this guarantees that you're at a bottom or near a bottom, but we think that they're good signposts and are helpful for us in validating that it's not just that the stock prices are down, they're down and people are selling and people are pulling away. And it's not just that they say that they hate them, they actually do really hate these stocks, and the funds are flowing quite aggressively away. And again, it's part of why we named the firm Bison. Everyone was pulling away from oil and gas stocks in 2015. So again, these things can take a while, but the thought was to face into the storm, acknowledge that these things that we were buying were deeply unpopular on an individual basis, and that the sector that we were deploying capital into, particularly the smaller caps, were particularly out of favor, and to intentionally go and buy these things that we viewed as undervalued and were in this sector that had these sort of cyclical tailwinds. And we think that those cyclical tailwinds have compounded, and that ultimately we'll see both for natural gas and for oil material upside versus current pricing. So we'll talk a little about what we do just on a sort of individual security basis, where it's helpful to have the confidence that oil and gas prices will likely rise to cyclical highs, and that they're not sort of going away in sort of figuring out what to buy, as well as that it makes sense to hold positions in a sector that's deeply out of favor, that everyone tells you, hey, sell and go buy the index or buy Berkshire or buy XYZ technology stock or venture investment or private loan or whatever. And so we like stocks that are cheap on a number of different metrics, that have assets that are high quality, not necessarily in the standard way that people measure quality, but in the ability to generate substantial free cash flow from those assets in a mid to high cycle environment. Management teams that, again, this isn't perfect, and we've been engaged in some vigorous discussion around one of our positions, but we do try to find people that have added substantial value over time. And we found that people that are really good at managing their companies do tend to deliver outperformance versus their comps and versus their sector over time. And then trying to find companies that have underappreciated assets and have sort of other potential catalysts has been really helpful for us too. And then, we try to buy things like more production, more reserves per dollar. And that's not perfect. And there's a lot of companies that are very cheap on those metrics that we don't own, but we find it's helpful to own things that are cheap and do have a lot of production, such that when prices rise, we're able to benefit from it. And if you think about sort of where Bison's excess returns came from, and where over the last decade, and then where potential excess returns, let's say for S&P 600 small cap versus XLE the large cap, a lot of the excess return could be explained simply through owning things that don't go bankrupt. And again, we've had individual bankruptcies, but for the most part, the bulk of our portfolio has been able to survive negative oil prices and so on. And a number of small cap energy companies have survived too, less than our portfolio, which I think helps explain some of the outperformance, but that's not really the point. The point is, if you can own something that's going to survive and costs close to half of what a large cap stock does on a per unit of production basis, and you get convergence in valuation or near convergence in valuation, you can materially outperform owning that small cap versus that large cap. So we think it's really interesting to be able to get that exposure. Similar idea on reserve value. Same sort of concept, getting to buy $1.6 million of reserves for $1 million is way more appealing to us than buying $460,000 of reserves for $1 million. Again, this doesn't mean that the large cap energy stocks won't do well. It just means that they're a lot less cheap on a sort of per unit basis on reserves than some of the mid caps, and then much less cheap than the small caps. And with that, I think that's it. So thank you all for joining. And here I'm going to take this off record and open it up for questions if anyone has any.